Hi there, folks. The dust is settling on the most recent reporting season. There were hits, there were misses, some big flameouts, and I'm joined today by Will Mumford, Deputy Portfolio Manager at Auscap Asset Management, to see how the dust has settled, see what some of the ideas are, and what some of the misses might have been. Will, thanks for coming to Livewire. Great to have a chat.
Thanks very much. Great to be here.
As I said in my intro, reporting season, some highs, some lows. What did you make of it?
Yeah, well, I mean, there was definitely a lot of volatility. Everyone's talked about the rise in momentum, quant strategies, and active managers are all really focused on beats and misses. But to be honest, that wasn't really, it's not really something that concerns us, because we think ultimately over time, what's going to drive the share price of a company is going to be what its earnings does over time. And to the extent you get a lot of movements in the share price because of reasons that aren't fundamental, well, I mean, that's a great opportunity for active managers. And it's also a great opportunity because it can be hard sometimes to know whether the right multiple for a stock is 17 or 18 times. But when you start getting bigger moves, the valuation argument also becomes a lot easier to make. So in a lot of ways, it makes actives' job easier.
Yep. ASX had a good month in August. Auscap ahead with both the two funds. What was behind it?
Well, I mean, some of our long-term holdings had great results, and that definitely helps. There's always a little bit of luck in reporting season. But I think what is interesting from my perspective is how do you try and get lucky or improve your odds over reporting season? And by that I mean, how do you look for opportunities where the potential downsides that can happen to you aren't that fatal, they're manageable, but you do that in a way where there's still the upside that's available for you. And the best way that I think you can do that, and Auscap thinks about investing as well, is to focus on quality. I mean, if you own businesses that are structurally growing, they've got aligned management teams, they've got a competitive advantage, they're on reasonable valuations, they've got good balance sheets, I think you'll find that when they do have the misses, they're generally somewhat forgiven by the market. The beats are still rewarded. And when there's other surprises that come out of reporting season, they tend to be more positive surprises than negative surprises on average.
Okay, so quality, bring it to life with an example for me.
Yeah, so one of the stocks in our portfolio that was up in August and has tended to have pretty good reporting seasons over time for us is Car Group. And I think that's a good example of a quality business with a lot of those attributes that I was just talking to. And I think one of the things you can think about with Car is, what are the things over an August period which could go wrong, and what are all the upsides? And you can compare the two lists. So if you think about what could go wrong for Car over reporting season, so it could have a bit of cyclical softness in one of its end markets in the demand conditions, but it's in a few end markets, so that's probably not the end of the world. It could also have its costs growing a little bit faster than the market expects, but that's probably because it's investing in new features, and the market's probably going to forgive that over time. And I mean, Car's also on a high multiple, like many tech stocks, but that's like many tech stocks, and it's not specific to reporting season. Then you think about what could go right for Car over reporting season. So they could announce a new product, like they've done with C2C payments in Australia, or they can move into a new geography like they've done in the US, or they can move into a new adjacency like they're doing in the boating market in the US, or they can announce an increase to their pricing, or they can announce a logical acquisition, or they can announce an AI new product or an AI productivity initiative. And so there's a whole bunch of different things that they can offer that aren't on offer to many of the companies that are on the ASX. Yeah. And so that's a way that the odds are a bit more in your favor. And I'm not saying that something can't come out of left field and impact the business, or it can't have a bad reporting season. But the idea is if you build a portfolio of stocks with some of these characteristics, well then you should be moving the odds towards your favor.
Talking about things that were out of favour and moved to being in favour.
Yep.
Last time I had a look, consumer discretionary has been one of the best performing sectors on the market for the year. Auscap, you guys have talked about that space. You know it quite well.
Yep.
I have owned a number of companies in that space. Where do you think we are in the cycle for the consumer? Because it's gone from being counter consensus to quite consensus today.
Yeah, I mean, I think there are a lot of reasons to be optimistic about the consumer. We've already had our tax cuts. We've now got interest rates that are being cut. House prices are moving in the right direction. A lot of the labour cost issues that have impacted the sector tend to be normalising now, and most of the retailers on the ASX reported really strong July trading, whether that's in Australia or in New Zealand. But I mean, to be honest, when I hear an investment thesis that's just about a cycle, I do get a little bit nervous. So I always like looking for businesses that can benefit from the cycle, but also have a lot of structural initiatives that they're doing as well that can also grow their earnings, whether that's a new product, a new geography, a new region, productivity initiative, etc.
Yep. Let's just stay with the sector for a
Yep.
while, because you speak to a lot of investors, talk to us about what you need to know about investing in tech, resources. What have you learned over the years about understanding that consumer discretionary part of the market?
Yep.
And what are some of the things that matter most?
I mean, I think you definitely want to be in the best ones, in the dominant businesses within the sector. And when they're doing well and your thesis is working, I think you've got to hold on to these stocks, which can be hard. I mean, we've bought, whether it's JB Hi-Fi, Eagers Automotive or Scali, all on single-digit PEs. And we've always thought that they're quality businesses that are better than average on the ASX. And today they're all on mid-20s PEs. And so I think you've just got to really remember that if you've got a dominant business that's growing on the ASX, that's really scarce. And sometimes that takes a few years for the market to realize that. So you've got to hold on if you see that and your thesis hasn't broken.
Okay, so talked about sectors perform well.
Yep.
You talked about multiple expansion on some of your key holdings.
Yep.
Do you still have conviction today, and what are some of your best ideas there?
You've got to acknowledge that a lot of those stocks that we've just spoken about, Eagers or Scali, have done well and their PEs have gone up and valuation does matter for us. But the thing I'd call out about the consumer space is that the cost bases of these businesses are relatively fixed. So when you do get an improvement in the demand conditions, that can really be explosive for profitability. So for example, if you think about Scali in 2021, the year after COVID, which was an extreme demand environment, but just as an example, its revenue was up 40%, and that led to profits up 100% that year. And that was even after it gave back all of its JobKeeper payments. That was just because of the operating leverage of the business. And so if you do have this improving consumer backdrop, and you've also got other initiatives for growth, that could be really meaningful for profits. And Scali's got a big profit opportunity in the UK, and Eagers has opportunities everywhere, to be honest, whether that's growth within the Australian business through acquisitions, whether that's its BYD joint venture, whether that's its Easy Auto business, which is now scaling up in the used vehicle space, or international opportunities. So they're both still core holdings for the funds.
Yep. Stepping away from consumer,
Yep.
Where else are you seeing opportunities across the market at the moment?
Yeah, well, one of the areas that's a bit linked is retail real estate. So that's an area where the operational conditions right now are super strong. So the centres are all completely full. There's a lot of demand to get into these centres, and the rents are structurally growing really strongly. And on top of that, there's not really any new supply of centres that's coming up because of high construction costs and the alternative uses of some of these sites. So you've got really strong operational conditions, and then you've got players in the sector, like for example, HDN today, which has a dividend yield north of 6%, and that's structurally growing over time.
Sorry, the company is?
HomeCo Daily Needs
HomeCo,
REIT,
all right.
which is, or HDN. And so it's got this 6% dividend yield that's growing over time, and it's also trading at a discount to the independent valuation of its assets. And everywhere we go right now, we're hearing that there's a lot of pressure for these asset valuations to go up across the whole sector. That's pretty universally agreed, because there's a lot of institutional demand for assets within the sector, and we've also got a more supportive interest rate environment. So if you've got a attractive dividend yield that's growing and you've got some upside from valuations, I think it's a nice risk reward.
We talked about a few things that did work.
Yep.
Something that disappointed, something that didn't work as you're expecting?
Yeah, well, I mean, a high profile and topical one is probably CSL. So I think the interesting thing is one of the best setups that you can have on the ASX is when you've got a great dominant business that the markets put it out of favour because of something that's transitory. But then on the other hand, one of the most dangerous setups in the market can be if you've got a maturing market darling that's now pointing to some structural issues. And sometimes telling the difference between those two categories is pretty hard. But if you go to what CSL was saying over August, they were talking about increased competition within its plasma business. They were talking about a diminished R&D competitive advantage. They're talking about vaccine hesitancy, increased competition from generics in the Vifor business, more of a reliance on cost out to hit its earnings growth targets. And they're making M&A decisions which don't really seem consistent with a company that thinks its growth outlook is really rosy. There's still some quality attributes there. We're going to keep watching the company. Tim's going to their Investor Day in the US in a few months. But I think the market was right to be pretty skeptical about the result.
When we opened the conversation,
Yep.
you talked about the fact that big moves and deviations in share price away from fundamentals can create some of the opportunities.
Yep.
Got an idea where you feel like that disconnect is in place and there's potentially an opportunity right now?
Yeah, sure. So one of the opportunities would be Sonic Healthcare, which is a global leader in mainly pathology, but also radiology. So over the August period, it announced that its profit or earnings per share between FY24 and FY26 was on track to grow about 25%. The market wanted about 3% more than this. And in response, share price is off 20%. So Sonic's really been battling with two challenges more recently. So one is that because of the COVID collection period, it had a lot of people in its cost base, and then when inflation hit, it was kind of caught off guard by that period. And secondly, there's been a new competitor within the Australian pathology landscape, a company called Foresight, and that's impacted Sonic's competitors more than Sonic, but it's impacted the whole sector. But if you look forward now, Sonic, it's exposed to the growing structural demand of healthcare and pathology needs. It's growing really strongly in high-value complex testing, where it's the leader, things like genetic testing. It's also growing successfully internationally, got the potential to benefit from an improved cost environment, the potential to benefit if competition in the Australian market does become more rational. The market's not giving any probability that we do get further indexation within the category or a move to private billing within the category. And longer term, it's also a beneficiary of AI and automation. So I think there's a lot of reasons to be positive right now.
Okay, valuation, can you touch on sort of what you see from a valuation side?
Well, it's attractive. It's on a below market multiple right now.
Well, Will, great to catch up. Thanks very much for coming in, giving us a bit of a download on what you saw during reporting season and some of the ideas you got going forward. It's great to catch up.
Thanks, Jimmy.
Ladies and gentlemen, I hope you enjoyed that chat with Will Mumford, Deputy Portfolio Manager at Auscap Asset Management. Remember, check out the YouTube channel. We've got fresh content like this dropping every week.